Good day, and welcome back to the Business Career College video series. In this video, we're going to look at Canada Pension Plan contributions from the employer's perspective. And from the perspective of the financial advisor, then this can be useful when you're giving advice to an employer from a benefits perspective, or it can be useful for the employee just to understand who's contributing to their Canada Pension Plan benefit. This is really most useful from a financial planning or group benefits perspective, probably not something that you would need for exam purposes. So the rate of contributions, we may remember, for Canada Pension Plan currently sits at 4.95%. And when we have a contribution to Canada Pension Plan, that contribution is made by the employee and matched by the employer. Now, both of these amounts are withheld as source deductions. That is, it's the employer's responsibility to collect these amounts and remit these amounts and it's to CRA, Canada Revenue Agency, that the employer remits these amounts. This is all held in trust. So when the employer collects these amounts, we have a trust arrangement created, and that means if the employer collects these source deduction amounts and doesn't pay it out, or doesn't remit it to CRA, we can end up with a problem for the directors of that corporation or for that employer when then CRA comes looking for those later on. So with those source deductions then, that's both the employee and employer portion. Now, it hasn't always been 4.95%. When Canada Pension Plan was introduced, the first year that we had contributions, 1966, this was just a 1.8% rate. Now, this assumes that this employee has an employer. A self-employed person has to make both contributions. So self-employed folks are contributing twice. That means they're contributing on 4.95% times 2, or 9.9%. And as we've previously seen, whoever is making contributions, whether employee, employer, or self-employed, we know that it's on contributions between the year's basic amount, or the year's basic exemption, and up to the year's maximum pensionable earnings, or YMPE. And of course, the year's basic exemption has been at $3,500 since 1994. The YMPE changes every year in response to changes in the average industrial wage. Currently, it's $52,500. That's as of 2014. And contributing at that 4.95% between that rate. When the employee contributes on the employee's portion, they get a tax credit. That's true whether you're self-employed or not. The employee's portion always generates a tax credit, and the employer's portion generates a tax deduction. Again, that's true whether you are self-employed or otherwise. Now, there are some funnies with employer contributions to Canada Pension Plan, some sort of counterintuitive outcomes here. So let's say that I have an employee, and this employee has 2 jobs. And you can have a couple different scenarios here. Maybe they work job number 1 full-time from, let's say, January to, how about August? And during that period, they make, let's say, $60,000. And then they work job number 2, a completely different job, job number 2, from September until December. And during that period, they make another, let's say, $40,000. So what's going to happen here is at this first job, we're going to max out their CPP. the employer and employee will both stop making CPP contributions once the employee has had income over the year's maximum pensionable earnings, of course, less the year's basic exemption. So once the employee has made $49,000 that year, that's when everybody stops making contributions. But here, when this employee starts a new job, that's when contributions resume. So now, both the employee and employer are going to resume contributions on that $40,000 of income, less that year's basic exemption. Now, what's going to happen at year end, then we're going to have an over-contribution situation. And on that over-contribution, then, what happens is the employee gets a refund. However, the employer loses their over-contribution. So in a sense, this second employer is just throwing money away into the Canada Pension Plan, money that doesn't actually help this employee to generate any further benefit. It's sort of a weird outcome with Canada Pension Plan. This is the same thing that would happen if this employee were working two jobs concurrently. So let's say we've got somebody who's working two part-time jobs, and that person maxes out on income at one of those part-time jobs, maxes out up to YMPE, for example, which probably isn't all that common. But if that should happen, same type of scenario, the employee may have over-contributed. They'll get a refund. The employer will not. So I hope that helps to understand the employer's contribution to Canada Pension Plan. I find it useful, and it's one of these questions that comes up periodically, especially when people maybe are thinking about going into business for themselves, or even business owners who have done this and maybe have some frustration about some part of this that they don't understand. So I hope this helps, and I hope you enjoy your continued studies. Thank you very much.